a re-recording. Hi friends, this LOS talks about expenses and covers various topics like general principles of expenses recognition, various specific expense recognition applications like how do we deal with depreciation, warranty expenditure, bad debt provision, etc. and how does these expense recognition choices affect your financial analysis. Before getting into various specific expense recognition practices, let us first try how IASB defines expenses. Now, according to IASB, expenses are decreases in economic benefits during the particular accounting period, which could be either in the form of outflows or any kind of depletion in assets. Now, as either assets coming down or liabilities going up. Now this in turn results into decreases in equity, and these decreases in equity are not linked to decreases which are related to distribution to equity participants. So expenses are nothing but those transactions resulting in assets going down or liability going up, and resultant impact is equity coming down. Basically it is exactly the opposite of income definition. Talking about a key concept from an expense perspective is a matching concept. Now matching concept arises because of accrual accounting. Now as per accrual accounting, expenses are reported when they are incurred and not when they are received. Now from a matching concept perspective, both revenues and associated expenses are matched and recognized in the same period, which means an expense is to be recognized in the same period when revenues are recognized for which expenses are incurred. Let us say that we have purchased an inventory in Q4 of 2008 and this inventory is being sold in Q1 2009, and hence if the revenues are being booked in Q1 2009, automatically the cost of COGS will be booked only in Q1 2009, and that's what precisely the matching principle is all about. Now, while as per matching principles, the expenses are to be accounted only when revenues are earned, so revenue timing and expenses timing are matched. However, there are other costs which are not linked to revenues, and these costs are called period cost. Now, what are period costs? A period cost results into expenses that are recognized in the period they are incurred and not linked to revenues. For example, an electricity bill payment would be accounted for in the month which is it paid or it is incurred. Similarly, admin cost and salary cost. Now you don't wait for revenues to be recognized for that particularly salary cost or electricity bill, and hence they are accounted for as and when they are incurred. One of the critical period cost is depreciation, which is accounted for in the period in which it is incurred. Now what is depreciation all about? Now depreciation is basically charged to long-term fixed assets. Now long-term fixed assets can be divided under two heads: tangible fixed assets and intangible fixed assets. Now tangible fixed assets example would be land, plant and machinery, furniture and fixtures, etc. And intangible would be your brands, licenses, copyright, goodwill. Now depreciation as a expense is linked to tangible fixed assets. Now how it is defined? A long-term lived assets provide economic benefits beyond one accounting period, and hence their cost must be matched with revenues of more than one accounting period. Depreciation is basically a charge for allocation of the cost over the life of the asset. So if an asset is purchased for 50 million USD and the life of the asset is 5 years, you would account for expense of 10 million USD each year, and that's what nothing but a depreciation is. So depreciation is charged for assets like plant and equipment, whereas amortization is charged for intangible assets like patents and copyrights. So for tangible fixed assets like plant and machinery and furniture, the terminology for allocation of cost is known as depreciation, while for intangible assets like copyright and licenses, the terminology being used is amortization. Land is a fixed asset which is not depreciated because fundamentally we assume that the land value will not really dilute, and land would be an asset which will be available for n number of years. Now if we really look at intangible assets, not all intangible fixed assets are same. For example, a brand and a goodwill would be slightly different kind of intangible assets. Now what is the difference? Now these intangible assets have got infinite life. The life, because a brand could remain a brand for a number of years. On the other hand, if you look at licenses and copyrights, now these intangible assets have got finite life. So all intangible assets which have got finite life, for example a license which has been purchased for 5 years will give you rights for 5 years. The terminology being used is amortization. For an infinite life kind of items or elements like brands and goodwill, the terminology being used is called impairment. Just to summarize what I've just said, a depreciation is a terminology being used for tangible fixed assets. Amortization is a cost allocation being used for intangible fixed assets with finite life. Example could be licenses and patents or copyrights which are there for a limited period of time. Impairment is a terminology being used for intangible fixed assets with infinite life. Example would be goodwill and brands. So the key issues related to depreciation. The other expenses which requires a matching principle would be, if a firm provides a warranty to the customer, the matching principle requires a firm to estimate a warranty expense. For example, if you are selling a product with a warranty of say maintenance for 3 years in 2009, you don't wait for the warranty expense actually to be incurred. So the moment the sales is incurred, an estimated warranty expenditure for next 3 years is booked in year 2009 itself. So recognize these expenses in the period of sale, which is 2009 in this example, with revenues rather than a later period when they are actually incurred. And that's where warranty expenses should be dealt with. Similar to warranty expenses are provision for bad debt, and they should also be recognized in the month of selling a particular product. For example, if a product is being sold in 2009, the estimated bad debt provision should be accounted for 2009 only and not when the bad debt actually get incurred. So if a firm is selling a good or services on credit, there is a risk that they might not be able to collect that entire money, and some of which customer might default. And hence, as per matching principles, a firm should estimate the bad debt expense. For example, a firm might be selling 100 crores of products every year, and they estimate about 2% they will not be able to recover, and hence 2 crore should be provision for bad debt that should be provided for in year 2009 itself. So it says, recognize these expenses in the period of the sale rather than a later period when they are actually incurred. So we should account for provision for bad debt in 2009 itself. Now, as we've seen that the provision for bad debt or warranty expense requires a lot of judgment, what would be the financial implication of such a judgmental tool? Now, what you've seen, just like revenue recognition, expense recognition also requires various kind of estimate. For example, for depreciation, we need to estimate the rate of depreciation and the period of depreciation, which is the life of the asset. For bad debt, we need to provide for what would be the likelihood percentage of sales getting resulting into a bad debt. Or warranty expense, how many customers could actually come back to us for replacement or of the product components under warranty scheme. So hence these judgment in estimations also becomes a management tool to manage their earning. So for example, if a management wants to really show lower profit, they can increase or accelerate the expenses and exactly do the vice versa for increasing their earnings. So because of these expense recognition flexibility, a company might either adopt an aggressive policy whereby they can delay the expenses and hence increase the net income, or adopt a conservative policy thereby expensing early. Now what does it mean for an analyst? An analyst's role is to probe these management estimation and try to find out that is the reason for change in expenses because of actual economic behavior of a particular expense. For example, if the rate of bad debt is changing, is actually the collection changing? If the rate of depreciation changing, is the nature of assets being really changed? Or if the warranty expenditure is being changed, does the past performance of warranty expenditure really demand such a change? Let us take a live example whereby a firm has decided that their bad debt expense has recently decreased. Now this is the announcement done by a firm, or an observation from their annual accounts. Now what does it mean? Now there could be two reasons for expense to decrease. Number one, either the actual recovery has strengthened because of which bad debt has gone down, or the bad debt expense without any reason has been declined so that the earning could go up. Now analysts should look into these two scenarios and then come to a conclusion whether the management is trying to manage the earning, or it is a real case where they had strengthened their collection team because of which bad debt expense has really come down, and hence the provision for bad debt expense coming down is realistic in nature and there is no need of worry to any kind of investor. The next few slides would basically deal with various kind of depreciation methods. The first method is straight line method. Now as per straight line method, it assumes that during the life of the asset the depreciation amount would remain flat. Now how does this depreciation amount determined? The depreciation expense is equal to the cost of the machine minus the residual value divided by the useful life. Let us assume that a plant and machinery being bought at 50 USD for just an example sake, and the life of the plant and machinery, let us assume, is 4 years. The residual value of the machine after 4 years would be, let's say, 10 USD. Now how do you calculate depreciation for 4 years when the machine would be used? Now, so how do you calculate the depreciation for year 1, and it will be same as for all the years, would be the cost of the machine, which is 40 million USD, minus the residual being 10 million USD divided by 4 years, which mean 40 million divided by 4, which is equal to 10 million USD. So under the straight line method, you would account for depreciation expense as $10 million for the next 4 years. The second method is being used for a kind of product which is expensed as and when being produced. For example, there could be a machine which has a capability to generate 1000 components, and after that you need to change that machine. Now assuming that year 1, year 2 and year 3 you use the machine in the following manner. Year 1 you manufacture 500 products, year 2 you manufacture 200 products, and year 3 you manufacture 300 products. Now in this way, as per unit of production method, you will account for depreciation in line with the production for that year. So assuming if the cost of the machine was 10 million USD, how would you account for depreciation then? The first year, how much machine have you used? For example, 500 components divided by, what was the total number of components? 1000, multiplied by the cost of the machine, which is $10 million. So effectively you have used 50% of the plant machinery, and hence 50% of the value of the machine would be accounted for as depreciation. So $5 million would be depreciation for year 1, 200 again 20%, which is $2 million for year 2, and $3 million would be for year 3 as a depreciation amount. One of the most frequently used method of depreciation is accelerated method of depreciation, which basically mean that in the initial year you would account for higher depreciation, and in the later year you account for lower depreciation because of the newness and useful productive life versus the productive life at the end of the period. Allocates high depreciation in early period of assets life because the assets are more productive. One of the most important method of depreciation. It basically works on the principle that the maintenance expense is initially higher, in fact initially lower, and hence the depreciation amount is charged a little higher, and thereby in the later part of the year when maintenance expenses are higher, your depreciation is lower, and thereby trying to keep these expenses constant over a period of time. So initially your depreciation would be higher plus your maintenance being lower, would then be equivalent to later years where depreciation is lower plus maintenance being higher. So they try to cap this exposure or expenses in line with the total expense year on year. One of the key method for under the accelerated method of depreciation is the double declining method. Very important from an exam perspective. Under the double declining method, the depreciation is calculated in the following manner: 2 divided by the useful life of asset multiplied by cost minus the accumulated depreciation of that plant. Let me give you an example. Let us assume that a plant and machinery is bought for 50 million USD. The residual value of the machine is 10 million USD. And the life of the asset is, let's say, 4 years. Now, how would the depreciation be calculated for year 1, year 2, year 3, and year 4? Now, the machinery, so from formula perspective, 2 divided by useful life is 4 years multiplied by the cost. Now, first year the cost is 50. There is no accumulated depreciation, so 50 becomes 50. This becomes 2 times, this becomes 25. So the year 1, the depreciation amount would be 25. For next year, what would be the first two items would remain same: 2 divided by 4 multiplied by the cost minus accumulated depreciation for last year is 25. So the year 2 depreciation would become 12 and a half, and so on and so forth. So this is the way how double declining method depreciation is calculated. Now here the critical point is you would keep on calculating depreciation only to the extent where the written down value becomes 10. For example, 25 and 12 is 37.5. The maximum residual depreciation could be 2.5, after which no depreciation would be charged because you've already written down the entire value of the asset, and that's very critical from an exam perspective. The next important topic is how do you account for cost of goods sold, which is basically the purchase price of an inventory, and how does that inventory consumption is matched with revenues. The first method is specific identification method, which says use this method when a firm can identify exactly which item is being sold and which item is remained in the inventory. For example, an auto dealer knows which car it's selling, so each car can be identified, and hence a specific identification method can be followed by a car dealer for accounting for cost of goods